All right, welcome to class, personal finance students. Today, in this explainer, we're examining an elegantly simple, century-old legal strategy. It's the exact framework that allows the ultra-wealthy to live like absolute royalty. Buying mansions, flying private jets, all while paying virtually $0 in taxes. I'm going to be your professor for today's Advanced Tax Strategy Seminar, and I promise you what we're covering today is absolutely going to change how you view money. Now, hearing a question like that, you might immediately think I'm about to teach you some sketchy offshore pyramid plot cooked up in the Cayman Islands. But let's just dispel that myth right off the bat. This isn't evasion. This is a perfectly legal tax code mechanic hiding in plain sight. It's been used by billionaires for over a century, while the rest of us get hammered by the IRS every single April. Okay, let's quickly run through our syllabus for today's seminar. First, checkers versus wealth chess. Then, Phase 1, buy assets. Phase 2, borrow collateral. Phase 3, die holding. After that, a case study with Maria's math. And finally, building your shadow portfolio. Part 1, checkers versus wealth chess, the paradigm shift. To truly understand this strategy, we have to experience a massive paradigm shift. Open your minds because we need to unlearn almost everything we've been taught about earning a living. See, most of us are essentially playing checkers. In the standard game, you go to work, earn a salary, and the government immediately takes its bite through income and payroll taxes before that money ever even hits your standard savings account. But the wealthy, they're playing three-dimensional wealth chess. They understand one crucial rule. The government cannot tax wealth that never gets realized as income. They don't actually want a massive salary. They want appreciating assets that generate zero immediate taxes. This game is so fundamentally different from how the middle class operates that law professor Edward McCaffrey gave it this really catchy three-word name just to help people grasp the mechanics. Buy, borrow, die. I know, it sounds almost entirely too simple, right? But the math behind these three words is astonishingly powerful.
Phase 1, buy assets, building the vault.
Every financial empire has to start somewhere, and the very first move is to buy appreciating assets. But and this is a huge but, you must absolutely avoid high dividend stocks or standard interest-bearing savings accounts. Why? Because a standard savings account pays you a tiny bit of interest every month, and that immediately triggers a tax bill. It quietly destroys the compounding power of your wealth. So the wealthy intentionally buy assets that don't produce regular taxable income. Essentially, you are building what we call a shadow portfolio. Think of this like a massive, impenetrable vault. Inside this vault, your assets are growing. Your net worth is climbing into the stratosphere. But because you aren't actually selling anything, the government just sits locked out on the sidelines. The IRS legally cannot touch a single dollar of that unrealized growth. Let's look at what's actually inside this vault. We're talking about growth stocks that reinvest their own earnings, real estate that steadily climbs in value over time, shares in private companies, maybe even fine art collections. These assets just grow, quietly, for decades. It is a fundamental contrast to that wealth-destroying standard savings account that's constantly leaking money to taxes year after year. Phase 2, borrow collateral, the debt loophole. Okay, here is the obvious problem, right? Grocery stores don't accept unrealized capital gains. You can't pay your mortgage with a stock certificate. So once this massive portfolio is established, how do you actually buy things? Well, you never, ever sell your shares to buy a yacht or a house. Selling triggers capital gains taxes. Instead, you use your shadow portfolio as collateral. Modern financial institutions absolutely love the ultra-wealthy. And they've created these highly sophisticated lending products just to service them, like securities-based lines of credit. Think of it like a supercharged credit card, where your investment portfolio serves as your credit limit. These products let you borrow millions. And here's the absolute kicker: the government does not tax borrowed money. So that $1 million loan flows directly into your checking account, completely tax-free. You live on it, and the IRS treats that cash as if it doesn't even exist. Let's walk through the math here to see why this isn't risky for them at all. Say your shadow portfolio earns an average of 8% growth over the year, and your line of credit costs you 6% in interest. You are still left with a 2% net profit. You're literally getting paid to be in debt. It's passive income on steroids, allowing you to live a lavish, completely tax-free lifestyle. Phase 3, die holding, the final gift. Eventually, our timeline runs out. But for the wealthy, this final phase tilts the playing field permanently for the next generation. When you finally pass away holding all these assets and all this debt, the game doesn't end in some massive tax penalty. Instead, you deliver the ultimate, completely legal parting gift to your family. This happens because of a very specific tax provision called the stepped-up basis. Under current federal tax law, your heirs inherit your assets not at the price you originally paid for them decades ago, but at their current market value on the day you die. It is essentially a giant legal reset button for your taxes. All those millions in lifetime capital gains, they simply vanish like magic. Your heirs can sell just enough of the newly inherited tax-free portfolio to pay off your outstanding loans, and they keep the rest completely clear of capital gains tax. Case study: Maria's math, the lab exercise. Now, theories and concepts are great, but as finance students, we need to see the proof. Let's run the hard numbers on a hypothetical investor named Maria who starts with a $1 million portfolio. Notice the mechanics when we contrast this against traditional retirement planning. In the standard game, traditional retirement, Maria grows her money, then rapidly sells off assets to live, which triggers taxes every single time. If she grows her portfolio to $2 million and sells, she pays a whopping $250,000 in taxes just to access her own cash. But look at the buy, borrow, die game. Maria keeps her $2 million intact. She borrows $1.4 million against it. Sure, she pays about $91,000 in interest, but her portfolio earns $160,000 in growth. The result? By borrowing at 6.5% while her portfolio grows at 8%, Maria is actually netting $69,000 in profit every single year. She is living off a massive $1.4 million loan that the government can't touch, and her underlying wealth is still increasing. Let's fast forward. 30 years later, when Maria passes away, her portfolio has compounded to $8 million. Because of that stepped-up basis reset button we talked about, her heirs inherit the full $8 million. They immediately sell off a tiny portion to pay back the original loans, and they pay absolutely zero taxes on 30 years of generational growth. Family wealth secured. Building your shadow portfolio, the assignment. This system is rigorous, and it operates exactly as the rules were designed. There are no loopholes here. It's literally just the tax code. Which brings us to your final assignment for this explainer. The essential lesson for your personal financial future is to stop chasing a slightly higher salary that only pushes you into a higher tax bracket. You have to transition your mindset. Stop being a wage earner, trading your time for taxed money, and start being an asset owner whose capital works quietly in the background. So how do you begin this transition right now? You start by maximizing your workplace accounts. Get those 401k matches, max out your health savings accounts. Then deploy that capital into diversified index funds or real estate that will appreciate without kicking off immediate yearly tax bills. And to help you stay on track, make sure you download our logic map linked in the description below. It's a fantastic resource to help you filter out those standard wealth-destroying assets. Because the fundamental difference between the struggling middle class and the ultra-wealthy isn't just the sheer amount of money they have. It's the elegant, strategic mechanics they use to keep it. The rules of the game are written. The only question is, how are you going to play your next move? Class dismissed.